What if I told you that the mortgage your bank approved you for, the one you signed, the one you are currently paying, might not actually be the best deal you could have got? And what if I told you that the bank knew that there are things lenders legally do not have to tell you, things buried in the small print, things that cost ordinary British families thousands of pounds every single year, not because they are doing anything wrong, but simply because nobody explained how the system actually works. Today, that changes, because by the end of this video, you are going to understand UK mortgages in 2026 at a level that most people, including some people who already own property, simply never reach. And that understanding could be worth tens of thousands of pounds to you. So stay with me. Every single minute of this video matters. Welcome to NestPath UK, the channel where we give you the kind of property and finance knowledge that used to be reserved for people with expensive advisors. If you are new here, subscribe right now because this is what we do every single week. Real information, real numbers, no jargon, no fluff. Just the truth about the UK property market, told clearly and honestly. Now let us get into it. Let us start at the very beginning, because even if you think you already understand mortgages, I promise there is something in this video that is going to surprise you. A mortgage is simply a loan secured against a property. The lender, usually a bank or building society, gives you a large sum of money to buy a home. In return, you agree to pay that money back over a set period, typically between 25 and 35 years, with interest added on top. And if you stop making those payments, the lender has the legal right to repossess your home and sell it to recover what they are owed. That is the basic structure. That is what everyone knows. But here is where it gets interesting, and where the things banks do not volunteer to tell you begin. The first thing most people do not fully understand is the difference between the interest rate they are quoted and what their mortgage actually costs them. Banks love to advertise headline rates, a big, clean number, 4.8%, 5.2%. It looks simple. It feels like that is your cost. But that number is almost never the full picture, because sitting alongside that headline rate is something called the arrangement fee. And in 2026, arrangement fees on some UK mortgage products are running as high as £2,000, sometimes more. So a bank might offer you a slightly lower interest rate, but then charge you a £2,000 fee to access it. Meanwhile, another lender might offer a slightly higher rate with no fee at all. And over the full fixed term of the deal, 2 years, 5 years, the total cost of the higher fee product is sometimes significantly more than the higher rate, no-fee alternative. Banks are not legally required to make this calculation obvious to you. They are required to show you something called the APRC, the annual percentage rate of charge, which is meant to represent the overall cost. But the APRC is calculated assuming you keep the mortgage for its entire term, which almost nobody does. It makes comparison genuinely difficult. And that confusion? That benefits the lender, not you. The lesson here is simple but powerful. Never compare mortgages by interest rate alone. Calculate the total cost, rate plus all fees. Over the fixed term, you are actually planning to keep the deal. That single habit can save you thousands. Now let us talk about something that is happening in the UK mortgage market right now in April 2026, because the timing could not be more relevant. The Bank of England's base rate is currently sitting at 3.75%. That might not mean much on its own, but here is the context that makes it fascinating. Just over 2 years ago, that rate was at 5.25%, a 15-year high that was deliberately engineered to crush inflation. It worked. Inflation has come back down. And through 2025, the bank made 4 consecutive rate cuts, dropping the base rate all the way from 4.75 to 3.75 by December. Mortgage rates were falling. Optimism was returning. People were beginning to breathe again. And then something happened that nobody predicted. Conflict erupted in the Middle East. Oil and gas prices spiked. Inflation risk returned. And just like that, the Bank of England held rates at its March 2026 meeting. Lenders, already nervous, began pulling deals from the market. Some withdrew products entirely overnight. others repriced upward. The average 5-year fixed rate, which had been falling, is now sitting at 5.75%. The average 2-year fixed rate is at 5.84%. And here is the number that should genuinely alarm anyone coming to the end of a fixed deal. If you roll off your current mortgage and do nothing, you land on the lender's standard variable rate. Right now, the average SVR across UK lenders is sitting at just below 8%. 8%. That is the rate you pay for doing nothing, for not taking action. And around 1 million fixed-rate mortgage deals in the UK are due to expire between April and September of this year alone. 1 million households facing that cliff edge. If you are one of them, this video is for you. Do not wait until your deal expires. Start looking at new products now. Most lenders allow you to lock in a new rate up to 6 months in advance with no obligation and switch to a better deal if something cheaper appears before completion. But here is what the banks really do not tell you, and this is one of the most important things in this entire video. There is a hidden world of mortgage products that never appear on comparison websites. They are not advertised to the general public. They are only accessible through mortgage brokers, specifically whole-of-market brokers who have access to lenders that do not deal directly with consumers at all. These are sometimes called exclusive products or broker-only deals. And in a market as competitive as the UK mortgage market, the difference between what you find on a bank's website and what a skilled broker can access for you can be significant. Not always, but often enough that using a whole-of-market broker instead of going directly to a bank or building society is one of the smartest financial decisions a UK buyer or remortgager can make in 2026. The broker fee, if there is one, almost invariably pays for itself many times over in rate savings and total cost reduction. Let us talk about how lenders actually decide what to offer you, because this is something that most people get wrong, and getting it wrong leads to rejected applications and damaged credit files. When you apply for a mortgage in 2026, the lender is not simply looking at your income and multiplying it by 4 or 5 to decide how much you can borrow. That old formula, that simple income multiple, is largely a thing of the past. Modern mortgage underwriting is far more sophisticated and far more personal. Lenders are now doing what is called affordability assessment. They look at your monthly take-home pay. They look at your committed outgoings, loans, credit cards, car finance, subscriptions, childcare costs. They subtract your living expenses, food, utilities, transport, entertainment, based on realistic spending estimates, and they calculate what is left, what is comfortably left over after all of that. And then they stress test that number. They ask the question, if interest rates rose by 2, 2.5, even 3% above this deal, could this borrower still afford the payments? If the answer is no, they lend less, or they decline entirely. This stress testing approach was introduced after the 2008 financial crisis to protect both borrowers and the financial system, and it is still firmly in place in 2026. Which means the number a mortgage calculator on a bank's website gives you is almost always higher than what an underwriter will actually approve you for. Knowing this before you start property searching can save you enormous heartache. Before you fall in love with a property, speak to a broker. Get a mortgage in principle. Know your real number, not the theoretical one. Now here is something that self-employed people, contractors, and limited company directors in particular need to hear, because the mortgage process for non-standard income earners is genuinely different, and the banks are not always transparent about how different it is. If you are employed and paid a salary, your income is easy for a lender to verify. 2 to 3 months of pay slips, a P60, and you are done. But if you are self-employed, if you take a salary plus dividends, if your income varies year to year, if you run money through a limited company, the lender's approach changes significantly. Most mainstream lenders will want 2 to 3 years of certified accounts submitted to HMRC. They will average your income across those years, or, in some cases, take the lower of the 2 most recent years. If you had one exceptional year followed by a slightly lower year, they might use the lower figure, And if your business is growing rapidly, if your income was $60,000 2 years ago and is now $90,000, some lenders will only recognize the $60,000 figure. That is a conversation worth having with a specialist broker before you apply, not after a rejection. Underwriting has become faster in 2026. Technology has accelerated it. Open banking means lenders can pull your transaction history instantly. Credit scoring is largely automated, but faster does not mean easier. The discipline of underwriting has not softened. What has changed is that preparation matters more than ever. If your finances are organized, your accounts are clean, and your documentation is ready, the process works beautifully. If they are not, even a strong application can run into problems. Let us talk about something that NestPath UK gets asked about constantly, and that is the question of loan to value, or LTV. Because this single number, the percentage of the property value you are borrowing, affects your mortgage rate more than almost anything else. Here is how it works. If a property costs £300,000 and you put down a £60,000 deposit, you are borrowing £240,000. That is 80% of the property value. Your LTV is 80%. Now, if you could stretch your deposit to $75,000, just $15,000 more, your LTV drops to 75%. And that 5 percentage point improvement can move you into an entirely different rate band, potentially saving you hundreds of pounds per year. Lenders price their best rates for the lowest LTV borrowers, typically 60% LTV and below. The logic is simple. The less you borrow relative to the property value, the less risk the lender is taking, and lower risk means lower rates. For first-time buyers, this can feel like an impossible circle. You need a bigger deposit to access better rates, but saving a bigger deposit takes time, and in the meantime, property prices might be moving. There is no perfect answer, but what there is clarity. Understanding exactly where your LTV sits and what tier of rates it qualifies you for is essential information before you make any offer on any property. A broker can map this out for you in minutes. That conversation is free with most brokers. Have it early. Now let us address the fixed rate versus variable rate question, because this is where people genuinely get themselves into trouble by making an emotional decision instead of a strategic one. Fixed rate mortgages lock your interest rate for a set period, typically 2 or 5 years. Your monthly payment stays exactly the same throughout that period, regardless of what the Bank of England does with its base rate. That predictability has enormous value for household budgeting. In 2025, 85% of UK mortgages taken out were fixed-rate deals. That dominance reflects how much British borrowers value certainty after several years of rate volatility. Tracker mortgages, on the other hand, move directly with the Bank of England base rate, usually at a set margin above it. If you had a tracker mortgage throughout 2025, you benefited from each of the 4 base rate cuts automatically. Your payment dropped 4 times without any action on your part. A borrower with £140,000 outstanding on a tracker mortgage saves approximately £28 per month for every quarter-point cut in the base rate. That adds up quickly across multiple cuts. The question of which is better in 2026 depends entirely on your view of where rates are heading, and that view has become significantly more complicated in the last few weeks due to the Middle East situation. Before the conflict, rate cuts in 2026 were considered near certain. Now some economists are even predicting rate rises before the end of the year if oil prices push inflation back above target. In that environment, where even the Bank of England is uncertain, the predictability of a fixed rate has genuine strategic value. Most mortgage experts currently suggest that fixing for 2 years gives you stability now while preserving the option to refinance at potentially better rates in 2027 and beyond, when the geopolitical picture may be clearer. One expert at Everest Mortgage Services puts it like this: the best window to look at new mortgage rates is likely September to October of this year, by which point one more rate cut may have been priced in by lenders, giving you a slightly better starting point for your next fixed deal. But timing a mortgage perfectly is not something most people can do. What you can do is act early, act informed, and act with the right advice behind you. Which brings me to one of the most important warnings we issue here at NestPath UK, the danger of the standard variable rate trap. We mentioned it earlier, but it deserves more time. When your fixed rate period ends, if you take no action, your lender automatically moves you onto their standard variable rate. The SVR is almost always the most expensive rate the lender offers. There is no competitive pressure on it. The lender sets it at whatever they choose. And right now, the average SVR in the UK is close to 8%. If you have a £200,000 mortgage and you roll onto an 8% SVR instead of a 5% fixed rate, the difference in your monthly payment is enormous. We are talking hundreds of pounds every single month. Every month you sit on the SVR without acting is money that disappears from your pocket into the bank's profit margin. Set a reminder in your phone right now. 6 months before your current fixed deal expires, start the remortgage process. There are a few other things banks are quietly not volunteering that are worth knowing before we close out today. One is the early repayment charge, or ERC. Most fixed-rate mortgages come with ERCs that apply if you pay off the mortgage, switch lenders, or make overpayments beyond a certain limit during the fixed period. These charges can be significant, sometimes several % of the outstanding balance. If you think your circumstances might change dramatically during your fixed term, a job move, a relationship change, an inheritance, factor this into your product choice. Some mortgages offer more flexibility around overpayments and porting the deal to a new property. These features have real financial value that the headline rate does not capture. Another thing, green mortgages. They are becoming increasingly available in the UK market, and some lenders are offering cashback incentives for energy-efficient improvements to properties. If you are buying or remortgaging a property with a low EPC rating, it is worth asking specifically about green mortgage products and whether any energy improvement incentives are available. This is a growing area and one where proactive borrowers are leaving money on the table by not asking the right questions. So here is where we land. The UK mortgage market in 2026 is genuinely complex. Rates that looked like they were falling are now under new pressure. 1 million deals are expiring in the next 6 months, and the gap between what a well-advised borrower gets and what an uninformed borrower ends up with is wider than ever. Understanding how LTV affects your rate, how arrangement fees affect your true cost, how lenders assess affordability, and why the SVR is a financial trap. That knowledge does not just feel good, it puts real money back in your pocket. At NestPath UK, this is exactly what we are here to do. Break down the system, remove the jargon, give you the information that lets you make smart decisions with your money and your property every single week. So if this video gave you something valuable, and I genuinely believe it did, please like it right now. It takes 2 seconds, and it helps more people find this content who need it just as much as you did. Drop a comment below and tell me, what is your biggest question about mortgages in 2026? Are you a first-time buyer trying to figure out your options? Are you coming to the end of a fixed deal and wondering what to do next? Tell me. I read every comment on this channel, and I will respond to as many as I can. Subscribe to NestPath UK if you are not already here. We publish every week property, finance, mortgages, the UK housing market, all of it explained clearly so you can make better decisions. And share this video with someone you know who is buying a home, remortgaging, or just trying to understand how all of this actually works. That share costs you nothing, but for them, it could be worth thousands. I will see you in the next one.